Welcome back to the table for the Friday, August 21, 2026 installment of Market Plus. Chris Robinson still with us here. If we had to do this 10 days ago, you would have been down in the dumps.
Yeah.
Why? Yes. Things change quickly.
Yeah.
What goes up can easily go down. I asked you about selling right now. If I'm not interested in selling, what do I do?
Absolutely, positively buy yourself a cheap put and hope that you lose the value on the put. It's not a trading decision. It's a defensive revenue position. So you're going to buy it, and I just mentioned it. You can protect 480 corn for 91 days for 12 cents. So it's $600 plus your fees and commissions. Corn can go to $17. You're not going to make a margin call, and you get to sell corn higher. Corn goes back to $4.25. You've got $4.80 covered. It costs you 10 cents. So you can turn it into futures. You can do whatever you want. That's what you do. You hope that we go higher. Really what it comes down to. Same thing with $12 beans. $12 beans might look really good if we go back. We started the year at $10.50, Paul.
Well, we did. And so part of this story that we're, I think, talking about is demand. And Scott in Wisconsin's first question is that. Demand is good for commodities. The dollar is cheaper. Yield is falling. Are grains priced accordingly, or is it still cheap in comparison to futures?
It depends on the supply that we have. At the end of the day, things like wheat, somebody's growing a wheat crop somewhere, everywhere, every month. But with the corn and the beans, if we don't have the supply that we thought we could, it would be supportive. We got to remember, in about another 2 months, they're going to start planting weather down in South America. Now, is this going to be an El Nino year? Blah, blah, blah. We have that risk every year. So if we've got pretty good supplies, if we have any sort of supply hiccup, that would push prices higher. He did mention, the dollar being lower. That always helps exports. The third thing is if we do get the inflation trade going back again. The big reason we had that big blow up during COVID was the inflation trade. That's why corn went from, $4.50 to $8 because you have money coming in on that long side. The thing is, it didn't last very long. So you were asking me before, will this last? I hope it does. But we've been through multiple 80-cent rallies. With corn, it just dropped 80 cents. Now we've rallied it all the way back. Soybeans had dropped $1.20. We rallied all the way back. So we could do that 4 more times. And again, how do you do that? You know where your sale targets are. And if you can't make the sale, you get some sort of a hedge. I like the puts better because you buy the hedge and then the price can go through the roof, which is what you want, and you're not making any margin calls and you haven't capped yourself at that price. The flip side is, why people don't like it, you buy a put and it goes worthless. I wrote about that in my letter this week. It's like, guy had 6 cent put on corn rallied 50 cents. He was upset that he lost the money on the 6 cents. I'm like, that is how you have to do it at the end of the day. And if you can't be comfortable with that, you'll always be angry. And you don't want to be angry. You want to stay in position, and you're at least with the put option, you have a chance to defend the revenue. And you always keep the upside open. So we've had 2 of those opportunities this year. Hopefully we get more in the next 6 months.
Well, this one's a simple one then. Matt in Ohio. Is this the beginning of a commodities supercycle?
I hope so, and my kids and grandkids hope so too, because that's good for everybody. A rising tide lifts everybody. It's more fun to hedge expensive corn than, $4 corn. It's more fun to hedge $16, $17 beans. And it also makes more sense economically. We've been in a 3-year downdraft, and then for about a month and a half, we set in a 30-cent trading range. So are we making a base? I hope so. At the end of the day, the markets are going to do what the market's going to do. We had a pretty big multi-year, like 7-year lows in the wheat. So the market got definitely oversupplied. Are we going to have a super cycle? That depends on the overall world economy and the weather.
And the weather this week, part of the story that kind of gets lost in this discussion, it's not crop tour, it rained all weekend. The morning news on the network side this week, pretty much every day led with some flooding in some spot across the country. So there's that story. So I know we had the question from Holtzview Farms about favorable crops and if it's there or not. But what I want to know is if this weather pattern continues, does that Is that what fuels us? Or is this just, we've already come to a point where the news is this is going to drive us through harvest?
I think it's going to drive us through harvest, and I think it's going to be a case-by-case basis whether or not too much rain helps or not. I think earlier in the year when beans were still, younger, there's that expression, beans don't like wet feet, right? So now that we're further along, and it might just help fill these plants out. But I think moving ahead, we're going to find out really, I think the big surprise from the tour was the lower yields, especially in the I states. We knew they were going to be lower eastern, but when they got into Iowa and Illinois, that's going to be a surprise. So will the rain help? I don't know. If you're a farmer and you're a bull, you're going to want to hope that these yields stay lower.
All right, let's talk about maybe not as much of a celebration right now, and that's in the beef industry. Scott in Iowa is writing about the quadruple whammy for beef. How low do we go in the cattle market? How many people are going to exit the business versus expand their herd? We are currently looking at losing a lot of dollars per head on the cattle in the yards that are there right now.
It's going to be I wish I had the answer to that. It's above my pay grade. I will say this, back in November, I keep talking about November, we were lows. We had a very good rally into May. We had a $90 rally in all-time highs. A lot of that was fueled by the border being closed and everything else. And I was here a couple times ago. We were talking about, are we going to get, $4, $5 cattle? It's like, it looked like it was never going to stop. So it's a lot. It feels to me like 2015, where the same thing happened. And then if you look at 2015, which is all we have to go on, was this history. We had a year and a half, 2 years of grinding lower prices till the market finds its base. So we'll have to see. But we've survived. First, we had the issue with New World Screw, right? Mm-hmm. That was a biggie. And then we had the border reopening. So this is the third thing. It's like, if this market can come back from this, that'll be very, very strong. But yeah, there's a lot of uncertainty out there. But like I said earlier, has all been lost? No, we've lost half. And that's just based on what the board is. And we can talk more about the difference between the cash and everything else. But there may be some pain yet ahead to go. And I think that if you're buying animals, you absolutely positively need to make sure you know what your break even is, because we could be back in fighting tooth and nail for profits.
I won't even tell you all the stories I heard this week
Yeah.
at the State Fair about folks who have some priced, some who have none priced.
Yeah.
And they're just like, well, it's worked for me so far. We'll see how it goes. But that's a dangerous spot, discussion for another day. Randy in Iowa, this one's an economic question. And how do you foresee the announcement from the Fed increasing buyback impacting commodity markets going forward?
That's probably the biggest question we're going to have in the next year and a half, 2 years. The debt's getting bigger, and what they're trying to do is, support all the markets together and calm down the bond market in particular. The bond market yields, especially in the 30 years, has gone higher. That's a more thinly traded market. The market's telling you that it thinks interest rates need to be higher. That's when you look at this. When the futures go down on the bonds in 10 years, it's pricing in the possibility of, certainly rates not going lower. So that's going to be something to absolutely positively worry about. It's already starting to be something where you're hearing more and more about it. And, if that was the cause, if you had an issue with the debt market, then that would flow through everything else. Generally, if that happens, and that's why I think you're starting to see a little bit of a recovery in the metals, because, silver went from 120 to 55. Now it's creeping back up above 70. Gold was 5,000 and came back down to 4,000. Now it's creeping back up. So I think that is something longer term that you're going to have to watch. And generally, if we get big inflation, I'll leave it at this. Historically, if you go back and look, commodities generally do well in inflationary markets. So that's the one saving grace.
Well, there's one sign of maybe that is what's happening.
Yeah.
Okay. Crude oil up 10% this week, but Jeff in Iowa wants to know, is it time for me to fill our fall fuel needs? Or do I wait?
I would say if we get a pullback, certainly look at doing stuff. We actually, about 6 weeks ago, we were down there. Crude oil traded to like 68. We had a recovery in diesel. Diesel fell back down. You got to watch the diesel. So it comes down to. So I think If we get pullbacks, I wouldn't be averse to doing it. What's the risk? The risk is we have problems in the Mideast again, and we go back up to $100 barrel oil. If that happens, then yeah, that's going to drive everything up. So how do you protect against that? Well, you buy where you need it, or you could do some hedges where you buy out of the money calls, either in diesel or in crude oil. And that's your protection, because if the market goes up, the calls gain value. Theoretically, the money that you gain on those calls, you use to pay for your more expensive fuel. So I would say, take a look at it. It might make sense to do something around a third. And the rest of it, I would look, if we get pullbacks, take a shot at buying some.
You have to defend your entire industry in this last question. David in Nebraska. About a month ago, the so-called experts said that we should have sold off all of last year's corn that was in the bins. Here we are. Corn that's 40 cents higher now than it was then. Do these experts tell us wrong on purpose so that we can panic sell so the traders can make money off of us farmers?
I wish it was that easy, but it's not. And I've been in this business for a long time. I spent 20 years on the floor. Nobody knows what's going to happen. I got news for you. They may think they do, but at the end of the day, the things I watch are every week the Commitment to Traders report. You can see which way those guys are bet. Back in May, which I think is what we're talking about, we were at 506 corn, and it was 3-year highs. The funds were all long. And yeah, absolutely, we told people to clean up your old crop sales when you were up at 506, not when we went down, and lost to 60 cents. So it depends on where you're looking at. I was aggressive at 506 because I knew guys needed to clean up sales. And if you didn't want to make the sale, hold on to your corn and buy a put, which is a substitute sale. If you bought a put back at 506, a 490 put, and we went down to 425, that was a really good hedge. So everybody's responsible for their own decisions. I follow everybody. I've talked to everybody. I've stood in the pit where people spit at you and try and stab you with their pencil if they don't like you. Nobody wants farmers to sell it in the hole. Farmers want, we want farmers to make money at the end of the day. And I think every marketing person out there, if we could tell you where the highs and the lows were, first of all, we wouldn't be doing it. But second of all, we wouldn't be recommending hedges. So now we're back up here at 3.5-year highs. I would say, yeah, if you've got old crop corn, sell it, sell what you need. But if you don't want to sell it, buy yourself a cheap put, But don't get mad if that put goes worthless and corn goes higher.
And on the way out, don't forget to look at 2027, right?
Yeah, 2027.
Real fast, be quick.
We're above $5 in 2027 D's corn, and we're right at $12. We started this year at $4.20 and $10.50. So all these commodities are at 3-year highs. Take a look at doing something.
We have to take a look at departing. Thanks, Chris.
Thanks. Thank you for having me.
Chris Robinson, everybody. Next week.
Thank you.
We are going to talk about the Mountain West and how it's squaring off over a shrinking water supply. And Brad Matthews will be back with us. Thanks for joining us. Have a great week.